What if I told you the secret to making more money in the stock market is to do absolutely nothing? It sounds crazy, right? We're always told to be proactive, to seize opportunities, to buy the dip, to sell the high. But in the world of investing, one of the most powerful, yet most overlooked, strategies is the art of strategic inactivity. Today, we're going to dive deep into why doing nothing is often the most profitable move you can make. We'll look at the data, explore the psychology that pushes us to act, and give you a new perspective that could save you from your worst financial enemy, yourself. Think about the last time you felt that itch. The market is volatile, your favorite stock is down 10%, and every news headline is screaming sell. Your heart pounds, your palms get sweaty, and you feel this overwhelming urge to just do something, anything, to stop the bleeding. So you sell, and a week later, you watch in agony as the stock not only recovers but soars to a new all-time high. Sound familiar? This urge to constantly tinker with our portfolios is called overtrading. It's one of the most common and costly mistakes investors make, and it's deeply rooted in our psychology. We are wired for action. When we face a problem, our instinct is to solve it. In many areas of life, this is a fantastic trait. But in investing, it's a wealth destroyer. Let's talk about Warren Buffett for a second. The Oracle of Omaha is famous for his buy and hold philosophy. One of his most famous quotes is, "Our favorite holding period is forever." He's not just saying that to sound wise. He understands a fundamental truth. Great businesses create value over time, and the best way to capture that value is to simply stay out of the way. He once said, "Lethargy bordering on sloth remains the cornerstone of our investment style." He's basically telling us that being lazy with your portfolio can make you rich. But why is doing nothing so effective? First, let's talk about transaction costs and taxes. Every time you buy or sell a stock, you're likely paying a commission or a fee. These might seem small, but they add up, like tiny termites eating away at your returns. More importantly, if you sell a winning stock that you've held for less than a year, you'll pay short-term capital gains tax, which is taxed at your ordinary income tax rate. That can be a huge chunk of your profits gone just because you couldn't sit still. By simply holding on, you allow your investments to grow with a much lower tax burden. Second, and this is the big one, overtrading makes you a victim of market timing. Trying to predict the market's short-term moves is a fool's game. Nobody, not even the most brilliant Wall Street gurus, can consistently predict what the market will do tomorrow, next week, or next month. They might get lucky once or twice, but over the long run, the odds are stacked against them. A famous study by Dalbar, which tracks investor behavior, consistently finds that the average investor's returns are significantly lower than the market's overall return. Why? Because they jump in and out of the market at the worst possible times. They buy high, fueled by FOMO, fear of missing out when everyone is euphoric, and they sell low, panicked by fear, when the market is crashing. By doing nothing, you avoid this emotional roller coaster and simply ride the market's long-term upward trend. Think about it this way. Some of the best days in the stock market often happen right after some of the worst days. If you sell during a downturn, you not only lock in your losses, but you also risk missing the powerful rebound that often follows. A study by Fidelity found that if you missed just the 10 best days in the market between 1980 and 2020, your overall returns would have been cut by more than half. Missing the best 30 days, your returns would have been almost wiped out. The cost of not being invested is often far greater than the risk of staying invested. So how do we fight this innate urge to act? How do we master the power of doing nothing? It starts with having a plan. Before you invest a single dollar, you need a solid investment thesis. Why are you buying this particular stock or fund? Is it a great company with a durable competitive advantage? Is it a low-cost index fund that tracks the broader market? Write it down. Your investment thesis is your anchor in a storm. When the market gets choppy and your emotions are running high, go back and read your thesis. If the original reasons you invested are still true, then there's no reason to sell. Next, automate your investments. Set up automatic contributions to your retirement account or brokerage account every single month. This is a strategy called dollar cost averaging. It takes the emotion completely out of the equation. You're buying whether the market is up or down, which means you buy more shares when prices are low and fewer when they're high. It's a disciplined, hands-off approach that forces you to do nothing but consistently invest. Another powerful technique is to simply stop looking at your portfolio so often. Seriously, if you're checking your stocks every hour or even every day, you're just torturing yourself. You're exposing yourself to the market's random daily noise, which will inevitably trigger your emotional fight-or-flight response. Try limiting yourself to checking once a week or even once a month. The less you look, the less tempted you'll be to make an impulsive move. Fill that time with something else. Go for a walk, read a book, learn a new skill. Your portfolio and your mental health will thank you. Consider the story of a study Fidelity supposedly conducted. They wanted to find out which type of investor account performed the best. The result, the top-performing accounts belonged to people who were dead. The second best performers were those who had forgotten they even had an account. Now, while the dead investor story might be more of a finance legend than a formal study, the lesson is incredibly powerful. The investors who performed best were the ones who were physically unable to meddle with their investments. They couldn't panic sell, they couldn't chase hot stocks, they couldn't time the market. They just let their money sit and grow. This isn't to say you should never sell. There are valid reasons to part with an investment. Maybe your original investment thesis was wrong, or the company's fundamentals have permanently deteriorated. Perhaps you need the money for a major life event like buying a house or retirement. These are strategic, planned decisions, not panicked, emotional reactions. The key is to distinguish between reacting and responding. Reacting is impulsive. Responding is thoughtful and aligned with your long-term plan. The next time you feel that itch to trade, take a deep breath and ask yourself a few questions. Has the fundamental reason I invested in this changed? Am I selling out of fear or as part of a well-thought-out strategy? Will this action get me closer to my long-term financial goals? More often than not, you'll find that the best answer is to step away from the keyboard, close the brokerage app, and go do something else. Anything else, embracing the power of doing nothing is a superpower in a world that constantly screams for action. It requires patience, discipline, and a deep trust in your long-term plan. It's about understanding that compounding, the eighth wonder of the world, works its magic over decades, not days. By learning to sit on your hands, you allow your well-chosen investments to do the heavy lifting for you. You protect yourself from your own worst instincts and give yourself the best possible chance of achieving your financial goals. So the next time the market gets wild, remember the wisdom of the forgotten portfolio, remember that lethargy is a virtue, and embrace the incredible, wealth-building power of doing absolutely nothing. Thanks so much for watching. If this video gave you a new perspective on investing, hit that like button and subscribe for more content to help you become a smarter, more successful investor. See you in the next one.